Okay, good afternoon, everyone. I think everyone who's joined is joining, so I will kick off. Welcome to the latest in our series of webinars to guide you and your clients through these unprecedented times. It seems hard to believe it's 18 months since we first heard about a new virus, and now it's difficult to imagine what life was like before. I'm delighted today to be joined by Sandra Munday and Tom Russell, who are going to guide us through today's topic of overtrading. As always, if you have any questions, please type them in the Q&A box and we'll do our best to answer them at the end. So without further ado, I'm going to come to you first, Sandra, if I may. Can I please ask you to define overtrading for us and bring the topic to life?
Afternoon, Jenny, and hello to everybody on our webinar today. Overtrading. What is overtrading? So overtrading is when a business is trading with insufficient resource to fulfill the demand that it has. And you asked me to bring it to life for you, so I thought I might do so with a little example of a hotel. I'm guessing lots of people have been to hotels and restaurants since the restrictions were lifted, and you might have found that demand is somewhat high, and potentially the resource in those businesses isn't quite as great as it was pre-pandemic. So you might have noticed that the menus are somewhat restricted in restaurants and hotels. You might have noticed that staff might be an issue for some of those businesses. Certainly in one of my local pubs, they for a while had to shut on a number of days a week. I think it was Mondays and Tuesdays, because they didn't have sufficient staff resource. Then more recently, we've sort of started to hear about some of the food chain supply disruption, be that because you haven't got enough HGV drivers, or maybe a few days ago, I think we heard about, when I was writing or finalising this presentation, about concerns about there being insufficient CO2 for, say, for example, the fizzy drinks industry, or in relation to some of the meat packing and processing plants, which all will have a knock-on effect for hotels and restaurants. And also hotels and restaurants might also be having issues, for example, with equipment. Say if you had a freezer that went down and you couldn't get a part that you needed, that's going to have an impact on the trading ability of that restaurant or hotel. And then I don't know how many of us have experienced recently, and I was very disappointed about a month ago. I tried to book up one of my favourite restaurants, actually, in Lymington, and I left about a month between booking and trying to book and when the event was going to be. Fully booked until the new year. Very disappointing. So I think we're really seeing that pent-up demand that's been building up whilst the businesses have been forced to be closed. And also we're seeing a lot of people having stayed in the UK for their holiday this year and taking advantage of our great local sort of restaurants and hotels. Does that help, Jenny, in terms of what a trading might be?
And I think your favourite restaurant is my favourite restaurant as well, but I've managed to get a cancellation for November, so hang in there, you might get in there.
You're just showing off now.
When does overtrading happen, Sandra? What sort of circumstances might lead to it?
Yeah, well, we typically see overtrading in a number of scenarios. So quite often you will see a startup having issues in relation to overtrading. Now, that will be probably because they've not been able to anticipate the demand that they might have for their business or service that they've recently started, and you can absolutely understand how that situation might arise. And we see quite a few of those, don't we, Tom? Yeah. And then, but then there's also the business that is expanded rapidly. Now, you don't see so many of those, but if you think about the situation that we've just had, we've had the forced closure of a number of hospitality type businesses. They are going to expand rapidly now, because that demand is there. The demand never went away. It's just their ability to trade went away. So those are typically the scenarios where you see overtrading. But there's also other things to think about. So that's on the sort of almost on the demand side, but then there's also the supply side to this issue of overtrading. So if we're looking about shortages in the supply chain, I mean, it's been all over the news very recently. HGV drivers are in short supply. So that's going to have knock-on effects for all types of businesses being able to get the product to where it needs to be. There's shortages in the labour market. When you look at, we've had really a bit of a perfect storm in relation to that. We've had people that have maybe been on furlough and had a think about, well, actually, what career do I want going forward? And maybe choosing something different. And then you've also had Brexit that we had, which really we didn't feel the impact of during the pandemic as keenly as we might feel it now. Certainly when you look at hospitality, a lot of hospitality was staffed by people, casual labour that was coming over from Europe, etc. And some of those people, beginning of the pandemic, went home and never came back. And then there are things like shortages in financial resource. If you think about the balance sheet of a business pre-COVID and now, they could look very different. Those balance sheets, you could see a lot of gearing in those balance sheets now, where businesses have had to borrow money during the pandemic, be that a bounce back loan, be that a CBILS loan, or other kinds of borrowings that they've had to put in there just to enable those businesses to continue. And the other thing that we're starting now to see is inflationary pressures. I think the Bank of England, I'm right in this, aren't I, Tom? But the Bank of England are going to have to revise their forecast as to where inflation's going. I think there's starting to be talk about interest rate rises.
And whether, I think the indication they believe it's temporary price pressures, but whether that actually happens remains to be seen. I think going next as these things work out in the cycle over the next 6 months, 12 months.
And then those businesses have then got to decide whether they pass on those rising prices to customers or not. If they choose it or decide that they can't, then those profit margins for those businesses are going to get squeezed. So you can see how that all starts to feed into this overtrading cycle.
Yeah, and interesting what you say about the financial resource. And obviously, with my background in banking, that's sort of a particular interest to me, or I always seem to focus in on that side of things. I think that's going to have an impact. And one of the things we were very interested in as bankers was always working capital. And what impact would the overtrading have on working capital for firms?
Okay, yeah, I think you're right. I think it could have a significant impact. Probably worth a quick recap, if I may, on what working capital cycle is. So the working capital cycle is a measure of the time that it takes for a business to convert its raw materials or its services that it provides into cash, which gives you an indication of what financial resource you're going to need to sort of spread that gap, really. So businesses look to manage that working capital cycle in a number of ways. And that might be by holding minimum quantities of stock and raw materials. And I think Tom's going to talk about that a little bit later. But if you think about that, if you're only ordering minimum quantities, you might not get such good discounts, for example. So there's all sorts of impacts about how you finance your stock. But obviously, if you're looking at our hotel example, you might have seen, and I've certainly seen this, that menus have become more limited, because what they're trying not to do is they're not buying in stock to keep it in the cupboard or keep it in the freezer. And what they're trying to do is to actually service the demand that they've got, but on a sort of limited resources basis, which makes perfect sense, and hopefully means that you get some good fresh local ingredients. But there is a sort of a downside to that. So what happens if your stock runs out? So nobody wants to be in a hotel or a pub without beer. So there's pluses and minuses to trying to manage how much cash you've got invested in your stock. And then some businesses, when they're seeking to manage this working cash cycle, or working capital cycle, sorry, they look to get efficiencies in production, and that makes absolute sense. So for our hotel example, it might be that they say that there's a minimum 3-night stay, because you would start then to get some efficiencies in terms of the costs associated with the linen for the business, for example. So there's various things that businesses might do in relation to that. And then also, to get more cash into the business more quickly, you'd look at selling your products and services quickly. So that could be, in our hotel example, rather than having, say, 2 sittings for dinner, you might have 3 sittings for dinner, so you get that money into the business more quickly. And also, those businesses will look to gather their cash more quickly from their debtors. So for the hotel, that could be requiring larger deposits for weddings and conferences, or having shorter payment terms post the event. And other businesses will also be looking to maximise their credit terms with their suppliers. So either that could be on a voluntary basis, so going to your supplier saying, guys, I normally pay you on 30 days, I'm actually going to need 45 days in the current climate. Or alternatively, and we see quite a bit of this, you get some of this happening involuntarily, and particularly where HMRC is concerned, don't you, Tom? Now, we're not advocating that you do this, but if a business has built up a debt with HMRC, there is the option to talk to HMRC about time to pay arrangements, for example.
Absolutely, thanks for that. Yeah, absolutely. I think hopefully everyone's now got a much better understanding of actually what the overtrading is. So I guess the next question is, what makes it happen?
Okay, well, when does overtrading happen? So I suppose once you've established how much cash you might need to fund your working capital, if you see a change in either the demand for your product or the supply, then you're going to have imbalances in that working capital cycle. So, for example, back to our hotel again, if you saw an increase in the number of people wanting to stay or eat with you, they will inevitably, that hotel will need more staff to service those guests, but they'll also need more food, they'll need more linen, they'll need more electricity. And when there are shortages in supply of such resources, then this will have an impact on the number of rooms for potentially that hotel could offer, or the number of covers that it has for dinner. So I suppose the hotel industry is somewhat fortunate in that customers tend to pay very shortly after they've received the service, but other sectors aren't quite so fortunate in that. So sometimes the disruption to the working capital cycle might come by customers delaying paying. And that will mean that businesses are likely to require more cash to be able to trade with, as it will need to fund items such as wages and salaries and suppliers before they receive their payment from customers. So if you think potentially here of, say, a construction company, which I know that Tom and I have dealt with, it's going to be a long time before they get their payment day. So getting their financing right to fund that working capital piece is very important. And then you might get a situation where you get some bad weather or something and the projects get somewhat delayed and they can't do the build. And so you can see how that working capital cycle tends to get disrupted by events that might occur. And some businesses post-pandemic might well find it more difficult to source good credit terms from suppliers. So suppliers will typically do credit checks on customers before offering credit. We'd always advocate that. But these businesses may well be much more highly geared now. They might have taken the CBILS loan, they might have taken a bounce back loan, they might have deferred their taxes. And so the impact on the creditworthiness of those businesses and the ability for suppliers to get credit insurance, for example, may have been impaired by this COVID period.
That goes to timing a little bit as well, Sandra, because the credit reference agencies will look at the statutory accounts, but they may, if those things haven't come through the statutory accounts yet, it may take a while for them to do that, and they may make assumptions which may or may not be true when they're assessing the credit risk, because they'll be acutely aware of the those issues affecting businesses. So.
Yeah, very good point, Tom. And then also when you're looking at the working capital cycle, again, you'll be looking at the amount of stocks you need to hold and raw materials. And the more stock you hold, the higher the cash requirement in the business is typically. And certainly some businesses would be looking to not manufacture for stock at the moment when they're trying to sort of manage that working capital cycle. And then there's inefficiencies either in production or the delivery of service, which again may be through no fault of the business's own. These things happen. So if you take, for example, the hotel situation, I said that there was a shortage of staff. They may well have got new staff in now, and they're trying to train those new staff. But what that typically means is that the person that's delivering the training is probably less efficient than they would otherwise be, because they're having to train someone. And the new person that's learning the job is also going to be slower. So the business may not be getting full value for those members of staff. So they're going to be paying for 2 members of staff, but potentially only getting, say, 1.5 persons output. So you can see how these things disrupt the working capital cycle. Is that helpful?
Yeah, definitely. So if you're managing the working capital cycle and it's not generating enough cash, what should the business owners be thinking about doing to support their businesses and enable them to carry on?
Really interesting question in these times, Jenny. So if a business needs more cash, there are typically 2 sources of that cash. Either the business owner puts more in by way potentially of capital or loans, or the business tends to borrow more money if they can't manage that working cash, the working capital cycle. So lots of SME type businesses have quite low capital resources. So how often do we see, Tom, companies with a share capital of, say, £100? It's not a lot to be running a business on. But the business owner, I mean, okay, I accept that business owners may well be putting loans in and other things. But if you think about those business owners, over the last 18 months, they've had a pretty rough ride as well. And their personal resources may be quite depleted to be able to continue to plough money into their businesses. So they may have had some help from the government, but if they've been shut for a period of time, that help might not have been anywhere near significant enough for them not to have to have dipped into personal finances to either support the business or to support their own families during that time. So the ability for them to put more money in by way of capital and loans may be severely impaired by the last 18 months. And then the alternative of borrowing, as we were saying, some of the businesses will be a lot more highly geared than they were previously. So assets available to offer a security to a typical bank loan may just not be there. Loan to values may just not work. So there might be some alternative sources of finance that those businesses may be able to tap into. And that could be things like invoice discounting, stock financing, asset financing, hire purchase. I think you're going to come on and have a chat about that in a minute, aren't you, Tom? So yeah, that's in terms of what businesses can do to generate some more cash. Those are the obvious ones, Jenny.
Yeah, thanks for that. And I know, as is a fairly common theme across a lot of the topics we've covered, early spotting of these signs and early decisions made to sort of try and mitigate them, it always makes a difference. What sort of signs could people be looking out for to get my words out there? What sort of signs of overtrading might they look out for in their businesses?
Yeah, okay. You're absolutely right about the point about early spotting. It means you have more options. And sometimes you can make a fairly small change and make a big difference to the outcome. So, for example, in our own business, we encourage general practice clients to set up regular monthly payments for the services that they receive. And that helps us receive the payment when it's due, but also means that we don't need to employ someone to chase those debts. So that's a positive on both fronts for us. But other businesses may have similar sort of situations that they could deploy in their businesses. But you asked what signs specifically someone should look out for in terms of overtrading. And that would be, there's looking about backlogs in fulfilling orders, where customers and clients might have to wait longer. So if you take the hotel example again, it could be looking at how long the queues in reception are, or how long people are having to wait between courses at dinner. And then there are things like, is the delivery process itself taking longer? So, for example, again, in my hotel, as I was describing, training somebody new can take that person longer to serve a customer than it might otherwise do. And then you look at whether the business is seeing an increasing turnover, but a decrease in profit. We have a phrase in our own business: are we being busy fools? Are we focusing on the right parts of the business? And then there's the overdraft facility. As a banker, you'd appreciate, or former banker, Jennie, you'd appreciate this. The overdraft facility might be being used more, or it might be being maxed out more often. That would be a sign potentially of overtrading. You might also see that your debtors are taking longer to pay, or that you're taking longer to pay your suppliers. I think Tom in a moment is going to talk to us about some ratios that you might keep an eye on, but the particular ratio I'm thinking of here is the current ratio, which is a measure of the working capital within the business. And then there are some more subjective signs of overtrading, such as tired, irritable staff that feel overworked, undervalued. You might see a higher level of staff turnover. You might see some wage inflation coming in there. And for our hotel example, you might also start to see some poor customer reviews coming on things like TripAdvisor, born out of frustration for having to wait for dinner or receiving poor service from an inexperienced or tired member of staff. So yeah, there's some interesting potential sort of signs there.
Excellent. Thanks for that, Sandra. Right, you can catch your breath now. I want to ask Tom some questions now.
Thank you.
We've talked a bit about the fast-growing businesses. And Tom, have you got any sort of put a bit of meat on the bones on that topic for us? How can these be managed if you sort of think about overtrading?
Well, you're quite right that the fast-growing businesses can often suffer from overtrading, and it can be of particular concern. These are the businesses where demand may be increasing week on week, month on month, and actually you need to increase, the business needs to increase its operations to meet that demand, just to stand still, I suppose, let alone give any sort of leeway there. So the key thing for fast-growing businesses, but all businesses, is to have good management information. So cash flow forecasts are key, so that you ahead of time can forecast what your cash requirement might be in 1 month, 3 months, 6 months, based on forecast increases of demand. Now you'll probably want to have various scenarios played out, from the most likely to perhaps more extreme scenarios. And it's worth remembering that if the cash flow you may have relied on a couple of years ago or months ago, may not hold true. The assumptions you used there may not be accurate anymore, given obviously COVID, Brexit issues are now coming to the fore a little bit more, I think. Take the fuel crisis we've recently had with natural gas prices. I doubt anybody had those kind of price increases put into their cash flow forecast even 2 or 3 months ago. Rerunning those now and testing those may give you a very different pinch point. Taking the hotel example, you typically have a seasonal type model, you'd imagine, in a hotel. You might be busier in the summer and less busy over the winter. As a result of COVID, you may have a longer season now. You may have periods where the hotel hasn't been open due to staff issues or having to shut because of COVID, to make the cash flow a lot more lumpy. So I think reviewing those cash flows, monitoring and changing your assumptions and running different models may help a business plan for the best and for the worst. Going back to what Sandra said briefly in terms of ratios, you could look at debtor days and creditor days are two kind of key things for the working capital cycle. Debtor days are the number of days on average it takes your customers to pay you. Now, a movement of a day or so here or there probably isn't going to make much difference, but if that figure is moving constantly longer, that's going to take more time for you to recover cash from your sales, and that gap will need to be funded. Creditor days on the other side of things, the amount of time it takes you to pay your creditors. Now, the longer that is, the better for you. But you really want to be inside agreed terms. If you go much beyond that, you'll start getting chased. That can absorb management time, being on the phone telling people that they're going to be paid next week. HMRC will start sending letters. And so I suppose if you go much beyond agreed terms, that can start causing problems, which will come to, and monitoring those so you can kind of preempt those problems, I think is and
helpful. Probably the last thing you want is for a supplier to put you on stop or cash on delivery, because that just compounds the problem you've got with your working capital cycle, really, doesn't it?
Yes, absolutely. That brings things right into focus, and they could even be on stop, which could severely hamper your business. So I suppose if you find in yourself deciding who to pay, that's certainly something you should be worried about. But monitoring the creditor days with part of your cash flow should give you some notice of that, so you can put some mitigations in place, which we'll come to later. One of the other, Sandra mentioned the current ratio, which is simply the current assets figure over the current liabilities. So a figure around 1 is a neutral, i.e. you have the resources to meet all your liabilities on a current basis. If that figure goes below 1 on a trend or is decreasing, that is something you should be looking at and probably think about. So monitoring these things and monitoring trends, I think, is helpful in terms of the planning. Sandra mentioned stocks as well. Just to go into a bit more detail, what you don't necessarily want to do is have huge stock holdings. It's have all the cash tied up in stock. Various organisations run just-in-time measures, but if you look at how the car companies, who are notorious for just-in-time, struggled when there was a chip shortage. They had all their chips either not being manufactured or on container ships or being flown over, and they had to actually stop production. Now, you could argue that if they built up a bigger stock, if they thought that might be an issue, they would have been able to continue production and actually now got a competitive advantage over their competitors. So I suppose looking now, especially with Brexit, dare I say, security of supply may be more of a concern than just the absolute efficiency. You're better off trading even at a slightly higher cost than you are just running it absolutely lean. And particularly, I suppose, in critical components, do you want more than one supplier available, so to give you some sort of security, so that you're able to actually meet demand as it goes up. Don't put all your eggs in one basket, I suppose, is a message on that. Now, ultimately, I suppose if you're a fast-growing business, do you continue to meet demand come what may, take those orders, or do you actually slow down a moment, to pause for thought, and just actually slow your growth down until the business can catch up with demand? is it necessary to, in order to satisfy your customers and meet demand, to actually say no, think about your product mix. Do you want to just focus on the most profitable products for a period of time and making sure you can meet the demand for those, rather than just saying yes? What you don't want, I suppose, is customers complaining, everyone being let down. That could go, as Sandra said in the hotel example, to TripAdvisor. It could damage your brand. And again, then you have a huge amount of management time dealing with problems rather than actually fulfilling the orders that you've accepted. And then the management information should give you information on what is the most profitable element, rather than just doing what comes through the door first.
Yeah. And I think a lot of the things you've described there, Tom, would apply to any size of business. I think probably just the issues are more obvious if you're a rapidly growing new business. I think that the ability to cope with those sort of things are not quite so obvious. So if we look at sort of businesses as a whole, what sort of things can they do to mitigate the risks of overtrading?
Yeah, I think you're absolutely right. It's normally more acute in the fast-growing businesses, but it does affect all businesses. So Sandra touched on the capitalisation and funding point. Now, I think a good example of that at the moment, very current, is the energy crisis. You're finding smaller suppliers who haven't got the financial resources to weather perhaps whether or not it was predictable, I don't know, the storm, are going bust. The larger energy suppliers, the big four, the better funded ones, are now taking advantage of that. They have the resources in order to be able to meet, to manage the increase in the supply, the cost of the gas which they need to buy. And I think the message to that is set up your business in a sustainable way. Make sure you're capitalised. Make sure you've got debt there. Make sure you've got room in your overdraft to weather the storms that come across.
Very easily said.
It is easily said. It is indeed easily said. And looking at the product mix on that as well. If you're an energy company, you only offer fixed costs. You've got very little ability to increase that. So do you just that's the model they went into? It hasn't worked out for some of them. Others have got a mix of variable costs and fixed costs. So again, they'll be able to increase supplies. So I suppose it's looking at the product mix on that. And should, without the benefit of hindsight, perhaps, if you do have increased demand, what can you do on the supply side to meet that? Now you've got assets available. How did you fund those assets in the first place is one point. So, for example, small businesses may want to lease rather than buy. They could use invoice financing to shorten the period of time it takes between getting the cash in and selling the products. And also you may want to run night shifts, for example, whereby you, instead of 2 shifts, you run 3 shifts a day if you're producing, to ramp up supply and sweat the assets a bit more, I suppose, in relation to that. Looking more medium and long term, you have the use of technology, you have the use of artificial intelligence, perhaps. Looking at the hotel example, the more modern budget hotels, if you look at what they're doing now compared to even 5 years ago, you'll find they're very lean model. It's automated check-in. There's very few members of staff on site. You probably have cleaners coming in from an outsourced company, one person on site potentially some of the time. They often link up with restaurant chains, so the catering is dealt with by the building next door, the restaurant chain next door. So they don't have expensive kitchen facilities. They don't have to employ staff to serve. And I think that is a very lean model that's led by technology and led by the business model. So if you can set your business up to operate in that way, utilize technology, that does reduce the risks in relation to overtrading. You're able to not have all the risk on your balance sheet effectively.
I do wonder whether some of the more luxury hotels what they will learn from the budget hotel sort of thing. They've got an interesting conundrum there, because what they won't want to do is to devalue their brand by getting rid of all the personal service, but actually to be able to meet demand in an efficient way, they may well be looking at some of the sort of things that the budget hotels have deployed.
And the hotels these days have sophisticated software that manage the hotel for you with minimal input, and all the bookings, etc., automated. And that use of technology, I think, will develop Of course, this is a more medium to long term issue. You aren't going to be able to just buy a new software program that sorts out your problem overnight. But in terms of mitigating, setting this up now, along with good funding, will put you on a more solid foundation going forward. And finally, I suppose managing customer expectations. At the point in time you are overtrading, it is better, I think, to call your customer and tell them there might be a delay because of whatever reason, rather than wait for the complaints to flood in social media. It could damage the brand, and certainly that is one of the negative impacts of overtrading, which could be mitigated by customer service. But of course, you need staffing potentially to do that, and your staff may all be working trying to meet demand. So it's getting ahead of that as much as possible and giving ourselves time to deal with that, and perhaps not taking the order in the first place, going back to my earlier comment on that.
Yeah, learning when to say no.
Yeah.
I suppose if we've identified that overtrading's happening, we've tried to do something about it, but it's not really worked. Where does it all lead? Where do we end up?
Well, as I mentioned, cash flow is key. The working capital cycle is key, and one of the tests for insolvency is that you cannot meet your liabilities as they fall due. That's the cash flow test. Ultimately, a business finds themselves running out of money, unable to pay its creditors. Those creditors then start calling, taking action, getting letters, and ultimately that leads to potentially someone taking action against you, which could lead to an insolvency scenario where the business is financially in serious trouble.
You mentioned insolvency. Is it worth just going into a little bit more detail about a couple of the options that are available at this time?
Yeah, sure, absolutely. So I suppose, especially in a fast-growing business, it's not necessarily a failing business in terms of it may have really high demand for its product. It may have an excellent product. It is almost a victim of its own success to a certain extent. So you're certainly into the realms of restructuring, recovery type processes rather than, say, a liquidation or winding up, which you might consider in a failing business. So looking at some of those, more rescue type processes, Sandra said, and it's easier said than done, put some more money in if you're the shareholder or the investor, the lender. That might not be possible. So moving on from that, it may be a case of restructuring the debt over a longer period of time. Now, you may be able to do that with your existing lender. You may need to introduce new lenders. They may have worse terms in terms of rates, etc., but you may be able to spread it over a more manageable period of time. You may be able to offer some security. It may be necessary to sell some or all of the shares of the business. Now, maybe galling, having built your startup to a point where you're successful, you have loads of orders.
But we do see a number of bigger businesses capitalise from the efforts of people that have developed a startup, and it bolts very nicely into their business, and they're just a better funded business and can take it to the next level. It's sad, sad for the founders, but we do see that.
Yeah, if you're not able to develop it, someone will come in and pick up what you've developed. So absolutely right. And I suppose it's conversations initially with the investors and the shareholders about those options, providing them with the information you've hopefully got about where the business is, and also in relation to other creditors, conversation with your landlord, conversation with HMRC about time to pay, should buy you time potentially to deal with those issues. But ultimately, there may have to be an informal or formal restructuring of the debt. And looking at, I suppose, more formal processes, there are options available such as restructuring plans, as creditor voluntary arrangements, or even administration. I'm not going to go into too much detail about those, other than to say that the restructuring plans were a new procedure brought in as a response to COVID. They are a court-approved restructuring whereby the company puts a restructuring plan to all of its creditors. The creditors have a view on that, and the court effectively rubber stamps it. The directors remain in control and run that through. We're seeing those on large, complex type businesses with large debt levels, purely because the cost involved of setting those up consulting with creditors and going to the court means it's probably prohibitive to
there haven't been
SMEs.
that many, have there? What was it? Virgin Active was
done one recently. Leisure gym company, which is, you can see that might work. It's a restructuring there, and there have been some others. But generally, I imagine a voluntary arrangement is probably more likely to be a useful tool to an SME. And that's just a formal agreement between the company and its creditors, which can be fairly drafted. It's got quite a lot of scope for drafting. You can be quite bespoke in relation to what you write. And the other process which the government brought in as a response to COVID was the sort of monitor role, whereby the company is able to obtain a moratorium from creditors taking action against it for a short period of time. It hasn't been particularly well used as yet. I can see a scenario where it would be used in relation to a business where they're under a lot of creditor pressure, but they had a restructuring waiting to be done, and they needed 2-3 weeks in order to allow that to happen. So that period of trading when the moratorium is there is overseen by an insolvency practitioner in a monitor role. But the idea is that the company doesn't go into a formal process like an administration, but often I think that may well be the outcome if the funding doesn't come through for issues we haven't seen a huge amount of that yet.
You could be waiting for 2 or 3 weeks for your financier to get the money to you, and you need some protection during that time. That could work well.
Yeah, so I think an overtrading scenario is more likely to be used than in a failing business.
Essentially, you've got a good business underlying it. It's just its financing is not where it needs to be.
But as I say, we haven't seen a huge number of those yet. Whether it will become more popular or relevant, I think remains to be seen a little bit on that.
Excellent. Well, thank you, Tom and Sandra. I think that hopefully it's a bit of a whistle-stop tour around overtrading. I think that, as always with these things, early identification and early action is key to getting yourself through it. And we've got a bit of time, I think, for any questions. I know we did have one question sent in already, so if anyone else has got any, tap away in the Q&A box. But Sandra, I'll perhaps come to you for this one. How can invoice discounting help support businesses as they expand, stroke recover quickly to avoid overtrading?
Yeah, that's a good question. Invoice discounting is certainly very useful in some industries. So, for example, it's been very well used in the recruitment sector. Typically, what happens there is you shorten the period of time between the issuing of an invoice and having delivered the services or the goods, and actually the payment time on those invoices. So that actually can really help in terms of cash flow and managing that working capital requirement, because you get that money into the business more quickly. There's obviously a cost associated with it, but then there's a cost associated with all kinds of finance. Where we find that works really well in a rapidly rising market for a business, but when that market it sort of falls away, as most markets ebb and flow, it becomes more difficult managing cash flow when you're sort of in a down phase as opposed to an up phase.
Yeah. I know certainly that's one of the tools as a banker that we would use a lot, was this working capital management tool, where you could look at the different types of finance and see how that affected the cycle really, and getting cash into the business. So I think, unless anyone's just typed to it, no, we don't have any other questions. So I think our contact details are on the screen there if anyone's got anything that they think of afterwards. And all that really remains for me to say is thank you to Lizzie in the background for moving the slides and keeping us in order. But really big thank you to both Sandra and Tom for sharing your experiences and your knowledge with us. Thank you everyone for attending and giving up your time, and let's keep in touch, and hopefully we'll get to see you all soon. Thank you very much.
Lovely to see you all. Thank you. Goodbye.